As of right now, the U.S. stock market is closed. NVIDIA Corporation, trading under the symbol NVDA, finished its last active regular session on August 4, 2026 at $211.94 per share, marking a gain of $5.23, or roughly 2.53% on the day. In extended after-hours action, shares pushed further up to around $216.39 as market participants continued positioning ahead of upcoming catalyst events. While standard Wall Street headlines attribute this recent upward push to generic hype around artificial intelligence chip orders, the actual mechanism behind the price movement is far more specific. Institutional investors are not just buying semiconductors, they are quietly pricing in a structural shift in how hyperscalers handle custom silicon versus third-party hardware. Most retail accounts look at current price-to-earnings multiples and assume the stock is either overextended or bound for an immediate retreat. Reality tells a very different story when you examine how data center capital expenditure budgets are actually being allocated across individual brokerage accounts and massive hedge funds alike. The broad market narrative surrounding NVIDIA stock suggests that competitors are rapidly catching up, that custom chips designed by big tech firms will soon erode hardware margins, and that growth must inevitably plateau. You hear this narrative repeatedly across popular investing sites and financial media channels. Investors looking for investment help often wonder if they missed the window or if holding NVIDIA stock alongside Apple stock or Tesla stock still makes sense for a long-term portfolio. Wall Street often sells the idea that high-tech chip makers face a cyclical cliff once initial infrastructure build-outs peak. However, a closer examination of order backlogs, supply chain commitments, and software lock-in reveals that the consensus assumption overlooks crucial operational moats. The common expectation is that hardware buyers can easily swap out processing units for lower-cost alternatives. The reality is that software layer integration creates an exceptionally sticky ecosystem. When institutions execute large block trades through interactive brokers trading platforms or adjust positions within Fidelity wealth management portfolios, they are betting on the entire architecture rather than just a physical piece of silicon. Taking a detailed look at recent stock movement, the ticker has demonstrated remarkable resilience across daily price swings. Over the past 52 weeks, shares have traded in a broad range between $164.07 and $236.54. Recent trading volume has consistently averaged over 130 million shares daily, pointing to sustained institutional liquidity. Notice how pullbacks toward key moving averages are repeatedly met with aggressive buy orders rather than prolonged distribution. When market volatility hits tech equities, traders utilizing SoFi active investing or Robinhood stock trading often see quick intraday dips that get absorbed within hours by larger institutional funds using interactive brokers platform algorithms. Earnings expectations for the upcoming fiscal quarterly report set for late August are driving a significant portion of this momentum. Analysts are projecting quarterly revenue numbers near $91 billion, which represents a massive year-over-year increase. The gap between what casual retail traders expect and what supply chain checks indicate is where trading edge lives. Retail market participants often focus on consumer electronics sentiment, whereas institutional capital flows on platforms like Schwab Intelligent Portfolios or Fidelity Brokerage track wafer allocations from fabrication partners, memory module supply agreements, and power delivery infrastructure readiness. Macroeconomic pressures, including interest rate policy shifts and global trade discussions, certainly introduce short-term noise, yet sector momentum across artificial intelligence infrastructure remains top-tier. When retail investors explore online investment options or build a self-investing strategy using SoFi Invest, SoFi Stocks, or Robinhood Investments, semiconductor exposure frequently forms the core of growth allocations. The question isn't whether broader tech spending will slow down eventually, but whether NVIDIA can maintain its dominant market share when it does. Comment below how many shares of NVIDIA stock you currently hold in your portfolio and whether you use Robinhood, SoFi, Fidelity, or Interactive Brokers to trade them. To understand why this company maintains such pricing power, it helps to look closely at its underlying business model. Beyond manufacturing high-performance graphics processor units, the company operates as an integrated computing platform provider. The company designs specialized microchips, high-speed interconnect networking hardware, and proprietary software development frameworks that allow developers to build complex applications efficiently. By bundling hardware performance with software libraries, the company creates a barrier that prevents enterprise clients from easily switching to competing chip providers, even when rivals offer discounted hardware alternatives. Looking back at earlier corporate reports and historical performance context, the business transitioned from a specialized graphics hardware supplier for gaming enthusiasts into an enterprise computing titan. Early investments in parallel processing frameworks laid the foundation for modern enterprise compute clusters. Past financial statements highlight how revenue, once dominated by gaming graphics card sales, shifted dramatically toward data center compute infrastructure over several consecutive fiscal years. This pivot transformed cash flow profiles, expanded gross profit margins significantly, and reshaped how analysts evaluate the ticker's long-term enterprise valuation. When building an intelligent portfolio or executing online investing decisions through an individual brokerage account, understanding this historical pivot clarifies why valuation metrics remain higher than traditional hardware manufacturers. Investors utilizing Robinhood app features, such as Robinhood fractional shares or Robinhood cash management, often look at raw share price without considering total addressable market expansion. Similarly, those managing long-term retirement accounts through Fidelity IRAs, Fidelity mutual funds, or Fidelity ETFs recognize that structural shifts in enterprise computing happen once in a generation. Looking ahead to future scenarios, the market continues to balance near-term catalysts against medium-term operational risks. Potential growth catalysts include expanded deployment of next-generation rack-scale systems, deeper integration with aerospace and autonomous driving software pipelines, and broader enterprise adoption across healthcare and financial modeling sectors. On the risk side, supply chain bottlenecks, potential export restrictions, power grid capacity constraints at data center facilities, and rising capital costs could create temporary headwinds for customer spending budgets. The key to evaluating NVIDIA stock over the coming quarters lies directly in tracking how reality measures up against elevated market expectations. If hyperscale cloud providers maintain or increase their capital expenditure guidance, while software monetization continues to grow, actual earnings performance will likely beat consensus figures, driving valuation higher. Conversely, if major customers signal a pause in infrastructure buildouts to assimilate existing capacity, the stock could experience healthy consolidation as expectations realign with near-term fundamentals. For investors navigating today's markets across platforms like Interactive Brokers fees comparison tools, SoFi robo-advisor options, the Fidelity mobile app, or the Fidelity trading platform, remaining disciplined is essential. Successful online investing relies on distinguishing between temporary market noise and genuine structural changes in business fundamentals. Whether you utilize SoFi ETFs, invest online tools, or traditional brokerage services, keeping a close watch on enterprise spending trends provides the clearest picture of where this market leader is heading next. In summary, current price action reflects strong pre-earnings momentum and solid institutional backing despite ongoing debate surrounding chip competition and capital expenditure durability. The expectation of imminent margin compression contrasts sharply with the reality of deeply embedded software ecosystems and robust supply chain commitments. By evaluating both daily swings and long-term business fundamentals, investors can make informed decisions as market dynamics unfold. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.